Welcome to Morningstar. I'm Larissa Fernand, and today is renowned investor and member of the Bombay Stock Exchange, Mr. Ramesh Damani. Mr. Damani, I'm thrilled to be talking to you today. Thank you.
Thank you, Larissa. It's always a pleasure, and thank you for having me.
So, Mr. Damani, you have been through numerous cycles: bull markets, bear markets, high inflation, high interest rates, low inflation, the pandemic, the GFC. How has your relationship with risk and your understanding of risk evolved over all this time?
Sure. The markets, as you are well aware, something's always happening every day. Today, it could be the Israel-Gaza conflict. Yesterday was Ukraine. Before that was global financial crisis. There's something always exciting and, demanding our attention all the time in the market. I think investors need to strip the difference between what we call risk and volatility. Volatility happens when all these particular events take place. Interest rate rise, the Dow Jones falls, the war breaks out, oil prices spike. Risk is where you feel the permanent loss of capital. And I think in India, in particularly, because it's a growing economy and because the markets have been doing so well over the last 30 years, I think we are a very volatile market, but we're not a very risky market. In fact, the risk in India is not owning stocks or being out of stocks and in cash for various points of time. Let me explain to you an analogy that your viewers might be better able to understand. Since the World Cup just ended a few days back, it's not totally asking us to talk about it. You have to approach stock market investing from the view not of a T20 game or a T50 game, but a test match. Because if you're doing a T20 or T50 game, what you're doing is trying to hit at every ball, trying to get runs on the board, trying to get the scoreboard moving. Whereas investing like a game of test cricket, you keep watching the pitch, and every day the market will throw you Reliance at 2,500, ITC at 400, Lever at 2,200. It'll keep throwing the pitch, but you don't have to do anything about it. You have to just watch and keep waiting till one day the market throws you a softball outside the off stump, full toss, and you hit it outside the park for a six. And that's what good investing is about, trying to find great value when the odds are in your favor. So to again repeat your question, I think risk is the permanent loss of capital. But if done wisely, you're not going to permanently lose capital. It will go up and down, of course. But volatility is what you deal with, and make it your friend, Larissa.
Okay. So then tell me about how your relationship with loss, because certainly there would have been bets that went wrong, or you missed fantastic opportunities. Either way, you lose out. So how do you cope with loss? How have you mentally dealt with loss?
I think the loss of missing out has been more painful to me. Warren Buffett taught us many years ago that you must invest in your circle of competence. Whatever you're comfortable with, maybe I'm comfortable in software stocks, maybe FMCG, maybe construction. That really doesn't matter. But you should get that part of the equation right when a stock in your circle of competence comes to a level that you should be buying. And to give you an example from my own career, while I got some things right, I occasionally miss the fat ball outside the off stump, as I said it. For example, Bajaj Finance, a company that's in my backyard, I kind of missed it in its first run up. And the stock went on to become one of the best performing financial stocks in India. And there's no excuse for me missing it. There's absolutely the ignorance of the opportunity cost me a huge amount of money. So I think that is always more painful. And it's very important for an analyst to be self-critical because I run my own money. No one really knows the mistakes I do, but I know the mistakes I've done. So while you're working for a fund or you're working for an asset management, at least someone may point out your mistakes. But for me, it has to be self-introspective. So I think the ones that got away, as they say, the fish that got away are the ones that bother me more than the ones that got wrong.
So if you say that you work for yourself, okay, how do you make sure that you're not getting lost in the echo chamber of your mind?
It's very simple. Markets are reality check every day. Much like as a baby will tell you if he's feeling wet or feeling hungry by crying, he will signal to the mother or the father that I'm not okay, that you better come and check on me. The market signals to you by this price action almost every day what's going on. Now, in the short run, as Warren Buffett again has said, that the markets are more of a popularity machine. The most popular stocks do well. But in the long run, they're a weighing machine. So we tend to look at markets not really in one-day intervals or 1 week or even 1 month intervals, but more in terms of yearly intervals. and the stock is not performing, you try and find the reason for that underperformance. Is it because the market is ignoring a good idea, or is it because the performance have been suboptimal in various places? So I think over time, markets will signal to you if you're right or wrong. And part of being a good investor is being know when to bet money on the table, put money on the table, and to stand by your convictions, and when to realize that you have a bad hand and to fold and get out of the market. So I think that keeps us engaged in the markets at all times.
What gives you sleepless nights since you manage your own money? It could be very stressful.
Oh, that's simple actually. It's my wife's cooking. No, I'm joking. She likes to get rid because when I say that. Well, we've all done well. We are products of the 90s in India for the last 30 years. I always say when I come back, the index was 1,000. Today it's closer to 65,000. We had a fabulous bull run, great opportunities to make money. So we've been very blessed in many ways. So what gives you a couple of things give you this sleepless nights? The first is, of course, when you buy a new investment, you always worry whether it's right or wrong, whether it will work or not work, whether your thought process is accurate or not. We really have the self-confidence, or at least I don't have the self-confidence to have implicit belief that only my stock pick is right and the rest of the market is wrong. To give you a more contemporary example, during the recent bull market, we turned very bullish on the public sector stocks. They were, as you know, the most hated stocks in the market. But what we saw was great value, clean order books, low multiples, good dividend deals. So we made a bet accordingly on these stocks. And after some non-performance for a few months, they really start performing. So during the time where they don't perform, you really get a lot of angst within yourself, whether it will perform or not, whether you're right or wrong. And you wait for the market to kind of reward that conclusion at some time. So I think till that performance sets in, you tend to have a few sleepless nights. And about my wife, I am joking.
Is there something you believed as a newbie investor that you no longer really believe in anymore?
Oh, absolutely. In fact, if you'll allow me, I'll share a quote again from my favorite guru, Warren Buffett, because I think that emasculates everything I have used to believe and now believe in now. And this is the exact quote. I'm going to read it out so your viewers can enjoy the full quote. It says, Warren Buffett says, time in the market and the wonder of compounding interest can make an average stock picker brilliant and transform a family of modest means to wealthy in the course of a single generation. Now, it's a very small quote, but when I was young, I thought markets are good places, but you made money, you couldn't really get rich in that. And after having lived in the market for 30 years and realized how small acorns grow into trees, to mighty oak trees, by investing wisely, I've become a big believer in that. And I tell everyone, it doesn't matter if you have 10,000 rupees or 50,000 rupees or 2 lakh rupees, start. And the younger you start, the more chances, the more probability that you'll be richer at the end of 30 years period. And here's a stat that will surprise a lot of your viewers, that even you start with any amount of money, if you manage to double it every 3 years, it's a hard ask, but it can be done. If you double it every 3 years, you will end up with 1,000 times the amount you started. That's the power of equity markets. And I truly believe that now. It was a hard time to believe it. And until you go through it, perhaps sometimes you don't believe it.
Is there any investment that you bought and then later felt very insecure about?
Oh, lots of them. I mean, I've got lots of stuff wrong. But here's the beauty of good investing, Larissa. Because we are patient and manage to hold on for long periods of time, we tend to make typical gains of stocks go up 10x, 20x, 30x. Whereas if you're wrong, you can only lose 100% of your money. So on the positive side, I made 20x in some stock. On the negative side, I lost maybe 60%, 70% of my money. So if you do the math, it works out pretty good. So I don't think anyone can bat 100. I mean, even the best strike ratio in Test cricket is maybe 40, 50. Here's a bit of trivia. Who is the best Test cricket batting average in India? And it's not Sachin Tendulkar. Maybe your viewers will come up with it. The point is that you are going to get things wrong in the market. Your analysis will be wrong, management will be wrong, conditions will change. But the question then becomes that you should not lose so much money that puts you in financial peril. So you buy businesses that will also, and keep businesses that also don't just double in money. One of the common myths in the market, as you know, is, oh, stocks double, let me sell half, so it's free now. That's ridiculous. You want to keep a winner, maybe it'll go up 2x, 5x, 10x, 20x after that. To give you a good example, when I bought my first great stock called Infosys, its market cap was 30 crore rupees, absolutely 30 crore rupees 93. Today it's trading now to 6 lakh crore. Now you tell me at what price should I have sold it? 60, 100, 200 crores, 500 crores, 1,000 crores. You can name the math. Whatever price you sold it, you probably are losing money today. So the key maxim for the market is to keep your winners and to not hope you have not too many losers.
What is a personality trait that you feel in your years of experience, an investor, it'll hold him in good stead?
Well, as you said previously, that I've had the good fortune to interview some of the best investors in the world, in India and overseas. And what I realized that the greatest investors, or the investors that I respect the most, are basically lone rangers. Okay, they think for themselves. They will run astonishing amounts of portfolio money, maybe $100 million, $200 million, sometimes a lot more than that, just by themselves. They don't have a research department. It's all figured out in their head. They don't try and nickel and dime the cash flow to the next two-digit number over the next 3 quarters. They just broadly see if there's value to that. Secondly, I find them they're very passionate about markets. I mean, they're just amazed that people pay them to do this. They would do it for free. They enjoy this business so much. So passion is very important. I think young people, if they think it's a job, you're probably not going to be good at it. If you think it's the love of your life, you'll probably be very good at it. I think it also helps to have intellectual curiosity. I think to how the world works, how things are valued, it really helps that. And more important than all of that is that intellectual integrity that you bring to an idea. This is your idea. You pay the consequences, loss or profit, and you're willing to stand by what you said. I think these things are some of the things that make for a very good investor.
And what is a red flag? What is one trait investors should, which just makes you say, okay, you're setting yourself up for failure?
Well, if they try to chase the crowd, I mean, we are, for example, known as value investors. We try to buy things cheap. It's like your mother told you when you went shopping, ki buy rupi ki cheez chamani mein khareedna, buy things cheap. I mean, that's the motto of a lot of value investors. A lot of investors will come up with a particular style, and then because that style is not performing, will move on to other styles. And then they get stuck in both ends of the trade. So, perhaps not being true to yourself is a red flag for many investors. Markets evolve over time, and styles change. But my feeling is that basic principles of the market, to buy with a margin of safety, to buy a good quality business, to buy a good management, won't change, because then there won't be principles. So my feeling is that over long term, the principles remain the same. You might just approach it or attack it from perhaps a different vantage point.
Would you consider yourself to be a successful investor?
I would. Here's my test for a successful investor. That in a market like India, that's growing at about 16, 17%, you get 2% as dividend. And to double your money every 3 years, you need 22, 23% compounded over long periods of time. You're able to do that, I think you're pretty successful. Well, have there been people more successful than me? Of course, there have been more people successful than me. Would I like to imitate them? Yes, I'd like to imitate them. But I have my own set of limitations. And broadly, my standard test for myself is, have I doubled my portfolio value every 3 years? And if I've done that, I think I do a pretty good job, and I can look at myself in the mirror and avoid, as you call, the sleepless nights.
You once said that someone should read at least 6 to 8 hours a day. Why read so much, and what sort of books do you recommend?
I think the raw material of this business is reading. And my wife often called me that you're a book with two legs, basically, because I read so much. And I used to read a lot more when I was younger. I think now with age, my capacity to read has kind of dimmed down. But it's very important to read. I mean, you just read basic good newspapers, books, philosophy. It's not particularly about investment that would help you, but just reading helps you because it opens up whole new worlds to you. So it could be biography about a sports star, it could be philosophy, it could be psychology, it could be about investment rates, any number of things you can read. And I think Munger has expressed this idea best. It's that you don't necessarily read today to get smart tomorrow. The knowledge that you read today compounds over a long period of time and comes back to you in 10, 20 years as wisdom. And that's what is required in the market, that when you see a great opportunity, you will not hesitate. You'll put your money on the table and bet on that opportunity. I think so. That's what I think reading does for you. I think if you don't read, you have no advantage over anyone who can't read, basically. That's my thought.
And my final question to you is, do you think how much of a role has luck or gut feel played in your investing thesis?
Oh, luck's played a large part. We're all what we call the winners of the demographic lottery, in a manner of speaking, that we were born at the right place in the right time. My father was a product of the stock market from, say, the late 50s to the 1975, when the market was going nowhere in India. It was a very small market. It was a backwater. The last street was a backwater. There was a Dividend Control Act, and stocks didn't go up. So I was born in the right place. I came to India at the right time. 1,000, the index is 65,000 today. So I've clearly, I'd like to think that I've been skillful in picking stocks, but that would be the wrong conclusion to come to. I've been lucky. I've been a part of India's great growth opportunity. I've been able to participate along with that. I think have I been able to maximize the opportunity ahead of me? Probably not, which is to my eternal regret. But we've had fun along the way, and we've enjoyed it, and we've financially prospered. So I've been very lucky. I've been in the right place at the right time, Larissa.
Why do you say you did not maximize the opportunity?
People who came to the market in the 80s and 90s realized what a great opportunity there was ahead of them, right? And say the opportunity was to make 1,000, and you end up making 200. 200 might be a large sum, absolute money, but it's not good as 1,000. I think in markets and in life and in movies and in sports, you want to go for the Olympic gold medal, the Oscar-winning performance. So the person in the market who does the best is the one the maximum zeros in the bank account. So clearly, I haven't been able to do that. A lot of my contemporary peers have been able to do it. So hats off to them. It is only a matter of inspiration. I think if you be self-critical, maybe someone else will learn from it and realize that you have to test yourself against the best. You can't be happy by saying, I've done well, I'm financially free, I live well, I can buy what I want. You have to say, did I do the best in the circumstances provided? So those are some of the regrets I do have.
So, but yet you are a success, undoubtedly.
Well,
Yeah.
I have two great grandkids whom I love very much, and I enjoy playing with them. So if you measure my life by the amount of fun I have with my grandchildren, Veer and Arna, so I'll give them a shout out. Of course, I'm happy.
That's lovely. And I think we can end on that note. Thank you, Mr. Damani. Thank you for your
Thank you,
time.
Larissa.
Thank you for listening. This is Larissa for Morningstar.